Hello and welcome everyone to this American College webcast on long-term care planning and retirement income. I'm Jamie Hopkins. I'm going to be leading you kind of through and being, in a sense, the moderator of today's session, and hopefully not speaking too much. My voice is a little hoarse today, but I've got two fantastic experts in here with us, and we'll introduce them a little bit more later on. Bill Borton and Deb Newman, two people I've known for a long time, very much respect their thought leadership and just kind of impact in the long-term care and retirement world. So two fantastic experts. Actually, both of them have helped build material for us in our Retirement Income Certified Professional Program, the RICP, here at the college. First thing I get out of the way very early on is our kind of plug for marketing, which is Cyber Week, Cyber Monday, I guess is today. Also Deb's birthday, so I guess we'll get that out of the way too, but happy birthday, Deb. But this week, there's essentially a discount on CFP, CHFC, CLU. There's a link there, americancollege.edu/cyberweek. So I guess college does Cyber Week promotions too. CFP, everyone kind of knows that. CHFC is the same material really as a CFP, a little bit different business process, and CLUs are traditional insurance program here at the college. As I said, kind of our three speakers here. I'll be kicking us off. We'll move over to Deborah to kind of set the stage for long-term care planning, go through some really great scenarios on long-term care insurance, how to fund this. And then Bill Borton will be kind of handling what we call often hybrid or asset-based products towards the end. And just kind of a quick overview, right, of what we're going to be doing, right? Kind of long-term care planning and then hybrid or asset-based. And we'll hopefully have some time for questions towards the end. I know this is an area that's kind of growing, new, exciting, and is impacting a lot of people personally. And we'll probably hear some personal stories as we go throughout this. One last thing I want to cover here, a couple of housekeeping items. So this is regards to our CE for the webinar. So first thing is if you're looking for CFP CE, this counts for 1 hour of CFP CE. We will read out two CFP CE codes throughout the webcast. I'll also have them on the screen. So in order to get CFP 1 hour, you have to write down both of those codes. If you want American College CE, so CHFC, CLU, RICP, any of the other designations we do, it also counts as 1 hour. For both of those, CFP and American College CE, you will need to fill out a survey at the end of the webinar and put essentially your name, student ID, CFP number, the codes, fill it out, submit it. It will be placed in the chat box at the end of the webcast. It will also be emailed out to all participants at the end of the webcast from GoToWebinar. You do need to complete that essentially by the end of the day. Essentially the survey form gets shut down at the end of the day. This is recorded. You'll also have access to a PDF of these slides at the end of it. For those of you who want state insurance CE, we do not submit these webinars for state insurance CE. Some states allow for self-submission. You will get a certificate of completion if you're in here the entirety of the webcast from GoToWebinar, and you will have the PDF of this, so you're able to self-submit that for an hour if you want, but we are not submitting state CE for insurance from our end. So that's kind of the, and if you don't want CE, don't need to fill out the survey at the end. Obviously, we'd like to hear your thoughts, but don't need to. Okay, so I want to just set the stage a little bit, and then we'll kind of get over to our experts here for today. And one of the first slides, and I've been starting to use this lately when I talk about retirement income planning, and really the thought is, what does the future hold? What does it look like for Americans? And for many Americans, right, this is what it looks like, right? A collage of people, different backgrounds, income, savings, right, pensions, no pensions, 401k, no 401k, and they're worried. They're worried because the future holds a lot of uncertainty. And what are they concerned about, right? They're concerned about these things. Do they have enough saved, right? Did they save enough? Can they save more? How are they going to make that savings last a lifetime? What's going to happen to healthcare costs, right? Almost everyone's worried about that. What's going to happen to the Affordable Care Act? Is our premiums going to go up? Are we going to lose coverage? That's something that you as an advisor, as an agent, are probably asked on a daily basis from your clients. And if you're not, you're probably worried about it for yourself. It's something that keeps Americans up at night. And when you do survey after survey, that's where people are listing one of their biggest concerns. And then the last one, right? Worrying about being a burden on family members. And that very much ties into what we're talking about today, right? They don't want to be a burden. They don't want to have to rely on charity of their family members to get them through retirement, to get them through a long-term care event. But the reality is, those are the things that people are concerned about. It's keeping them up at night, right? And that's not just one person. It's not the 5 or 6 faces we showed at the beginning, right? And this is a number that you've probably all heard, right? There's 10,000 of these people hitting age 65 every day. And they're heavily reliant on Social Security. And they're worried about what happens to Social Security. They're heavily reliant on Medicare and Medicaid and what happens if those programs change. Now, a stat that's actually both, I would say, a good and a bad thing, right, is only 44% of retirees get any professional help. Well, I say, why is that any shape or form a good thing, right? Well, most Americans don't get help. Well, that means there's an opportunity to impact the world by getting more people the advice that they need. So that's an exciting thing from a financial advisor, from an insurance agent, from somebody who's focusing on helping Americans, which I know, that's what the American College alumni do. They help people, right, get in a better financial situation. And so there's an opportunity there to help people. If that was 100%, they wouldn't need our help, but they do. Now, why do they need help? Well, it's really what retirement income planning is, and this is a quote that I use about how I define it. And retirement income planning to me is like trying to hit a moving target in the wind. Well, what's the target, right? That's our goal. What do we want to accomplish? And why is it moving? Because we don't know how long we're going to live. And why is it like there's wind? Because things are going to change along the way. If we knew we were going to live, right, 22 years, 3 months, and 5 days, we could develop an income plan for that. If we knew we were going to have long-term care for 3 months or a year and a half or none at all, we could develop a better plan. But things are going to change along the way. We're not exactly sure where that target is, and it's going to continue to evolve and move over time. As I said, a lot of different aspects here, right? Mixing our, kind of public benefits, our Social Security, our Medicare, our Medicaid, in with healthcare planning, in with life insurance, when to retire, long-term care planning, where to live, how are we going to get care? And those are all the risks, all that wind we face along the way. And then what I really view this is goal-based planning. We start with that target. We look at the client's goals. We address the risks, right? The wind along the way. And that's how we put a secure plan together. And today, one of the big wins, one of the big risks we're going to be talking about, to me, is the single, kind of most unfunded retirement risk out there, right? And that's long-term care. That risk of needing care and not having family or even having family provide it, but we don't have great plans in place yet today. And that's then where I want to transition over now to our first guest, a fantastic expert. Now, I think I've known for maybe 7 years. I've been working with Deb, who came in and helped us build out the original long-term care section of the RICP. So, Deb, I know it's your birthday, so I want to thank you for joining in with us today. And feel free at this point to kind of take it away and tell us what we need to know about long-term care planning.
Well, thank you, Jamie, and thank you for the birthday wish as well. What I wanted to share with you is that what I've discovered, and I've been focusing on long-term care planning for almost 30 years, and so have been through a lot of the roller coaster that's going on, and it has gone on in this industry. I actually believe that we are poised for another surge in this business, and so that's one of the reasons why I'm so excited about this opportunity. So what I would like to challenge everybody that's on the call to create what your belief is around this. After this call, just sit down and say, what is it that I genuinely believe about this? And then create a plan in order to take care of your clients. So I'm going to share with you some information which will maybe shape your beliefs. But if you have 200 or 300 clients, there are a lot of people within that community that are going to be impacted. And one of the other things I believe is that the people that need care will get care. So, it's funny. We're worried about what's the plan for the people that need care. But the reality is that whoever they are, somebody is going to take care of them. Now, it may not be somebody that's raised their hand and said, hey, yeah, I'm in for this job. It's going to be somebody that ends up doing that caregiving because there wasn't a plan. And so Simon Sinek did one of those early TED Talks and talked about what is the why of your business. Why is it that you do what you do? And my why is driven for the passion that I have around the caregivers and what happens to those caregivers behind closed doors, every single community in America. And there is a lot of unpaid caregiving going on and impacting people profoundly. That's part of another discussion, but I just want to make sure that you understand how significant that is to the people that you take care of, and not only the person that needs the care, but potentially even the next generation down, and how it's going to impact them. So, Jamie, you talked about 10,000 people a day turning 65. Well, that's old news, right? Now, here's the new news, that in the year 2030, which is, by the way, just right around the corner. I believe it's only 11 years from now. It's crazy to think it's only 11 years from now. 11 years from now, the leading edge of the baby boomers are going to be turning 85. Now, maybe not 10,000 a day. Maybe we'll have lost a few by then. But even if it's 9,000 a day turning 85, that's when this problem is going to emerge. And it's going to emerge in a way that nobody is thinking about in terms of what you just said, and that is that people are depending on family and they're depending on government programs. Well, when that surge begins, the government will do one of two things. They're going to probably diminish benefits and or increase funding, which is taxes. So it is going to impact each and every one of us in ways that we have not even considered yet. So I want you to understand how impactful this is going to be on the 300, 200, whatever it is, the number of families that you're responsible for, and finding out what their plan is. So that's the frame that I'd like to start this on. And, I will share with you that in our agency, first of all, we are growing. This year we grew by like 25%. So there is already beginning a surge. And from my point of view, it's about the plan, not whether it's a long-term care standalone policy or a hybrid or linked benefit. Just having a solution in place is what's imperative. Your decision as to which way you go with it. And I love both. So, why is this so impactful? Well, because I remember when I was growing up and my grandparents were in their 60s, they were old. They were already old. And they died in their late 60s or 70s. Now, one grandfather lived to be 98. And now that's my experience with my parents getting into those ages. And it's not an anomaly. For a 65-year-old couple today, there's a 50% chance that one of them is going to live to 93. And you can well imagine what happens when you live to 93. You need care. And by the way, if you're 93, chances are your spouse, if they're still alive, is also 92 or 93, and that's your caregiver. So you can see why this is a phenomenal problem that we're already experiencing, but we're going to experience in spades in just a few years. And one of the other things about this is it's hidden, right? Because it's going on behind closed doors, because most of care is actually going on in people's homes. And the people that are needing the care are not out in the community, so it's not visible. So now I want you to think about this in a different way than maybe you have in the past. We've all been relying on some stats that I think were old. I'm going to tell you some stats because I want to motivate you. I will tell you, please don't use this to try and motivate your client, because statistics will never motivate them. Whatever the number is, they're going to assume that they're in the other part of it. If it's 90% of people needing care, they're going to assume they're the 10%. So stats don't motivate your clients, but I want to motivate you because I want you to understand how this impacts those families you're taking care of. So there was a study that was just published in 2016, and it was done by the U.S. Department of Health in 2015. So this is very recent. And what they did is they determined that 52.3% of people over the age of 65 will need long-term care as defined for at least 90 days. And they talk about the averages being between 2 and 3 years in terms of how long people will need care. But they're defining it as 52.3% of people over 65 needing care. And so I looked at that and I thought, okay, well, that's less than we've been professing for years. But then I went to two actuaries and I said, if there is a risk of 52.3% of us over 65 needing care, what is the risk of 1 out of 2 people needing care? So all of you look at your book of business, if you work with mostly couples perhaps, and you look at a couple, what is the risk that 1 of them will need long-term care? And so I asked 2 separate actuaries and they came up, fortunately, here's the good news, they came up with the same answer. And the answer was 77.2% of couples, that are over the age of 65, it will impact 1 of them. So when you look at the families that you are responsible for, over 75% of them are going to be impacted by long-term care. So you cannot ignore this. And the other thing that I hear financial advisors talking about all the time is the money, right? It's all about, well, my clients have plenty of money, so they don't need to have a plan for this. They still need a plan because they need to give permission for the family to hire someone to help them. Otherwise, you're going to destroy the health of that precious caregiver. So, and then we already talked about the leading edge of the baby boomers turning 85 in 2030. And we've all probably seen the statistics about if you turn 85, and what percentage of people are actually going to get dementia, and it's profound, right? So that's where we're headed, and we're headed there really quickly. So what I want you to do is think about how you're going to protect the families that you're responsible for within your portfolio and how you're going to help them be prepared for this. So now let's talk about what long-term care is. So if you get really motivated by this and you're like, oh my gosh, I'm going to talk to everybody about long-term care, you have to still remember, if you say those 3 words, long-term care, what pops into their mind are 2 things. Number 1, the nursing home, and number 2, he's going to try and sell me here. She's going to try and sell me some insurance, and I know it's going to be expensive. So they already have the wall set up for your conversation around this. So what I want you to make sure that you start communicating to people is long-term care is about what happens in people's homes. And I'll share, again, this is a statistic for your eyes, but I think this one tells a story that you can share with the client, and that is that 80% of care is going on in our homes. So you don't have to imagine living in a nursing home in order to still need care. And in fact, if it's going on in our homes, now you can understand the impact that it's having on the caregivers. So I'll share with you real quickly a story, as Jamie said, share a personal story about my dad. So my dad is 96, and if he was on this call, he would be participating, and you would not know that he wasn't vibrant, active participant in society because he's very alert. He watches the ticker tape twice a day, so he knows what his portfolio is worth. He knows who scored what touchdown in every game that was played yesterday and the ones in college on Saturday. So he's very vibrant. So I called home. They live in Chicago, and I would call home and say, hey, how's it going? I talked to my stepmom. She's like, oh, yeah, we're fine. Yeah, we're doing just fine. I'm like, wow, that doesn't sound fine. So I talked to them. I said, let's get a care coordinator in there to kind of assess what's going on. The care coordinator calls me. Now, keep in mind, I've been in this business 30 years. She calls me and she says, Deb, your dad needs help with 5 out of 6 activities of daily living. And I did not even witness that because he's so vibrant and participatory in every aspect of life. But he was wearing out my stepmom after we'd leave. You know, I mean, we didn't witness it, but that was happening in my own parents' home. So 1 week later, and I can remember them saying, you know, they said, let's get home care in there 4 hours a day. And I can remember them saying, what is this person going to do 4 hours a day? And I said, I don't know, but let's see what happens. I call the next week and they're like, oh my gosh, we love Sarah. We're doing great. It's fabulous. It changed their lives. And so I wanted to share that story with you so that you understand that home care is not, or long-term care is not, as Bill Comfort, good friend of mine, would always say, it's not laying in a rented hospital bed in the dining room where you're horizontal in the bed and your family is all hovering around you, whispering because they don't know what to say. Long-term care is still participating every day in your family's life, but you need help. And that help wears out everyone around you. So that's a discussion to have with people, is what is long-term care? Really define it. What is it? That's what it is. Now, does it happen in a nursing home? Yes. And you can see by this that 13% of care is actually happening in nursing homes, but 80% is still happening in our own homes. So if that's the case, then what I want to share with you is that when you're trying to solve long-term care for your clients, solve for where 80% of the care is going on. So I think one of the problems that we've experienced over the last decade is that advisors are saying, well, how much does it cost a nursing home? Oh, it costs $100,000, $89,000. So should we fund for $7,000 or $8,000 a month long-term care? Then they do the pricing on that, and the client simply shuts down. They say, I'm not going to pay $7,000 or $8,000 for long-term care. So, and what some studies that have been done by companies with enforced policies have experienced the fact that people are not using the policies that they have to the maximum levels that they've insured. They've overinsured the risk. So what I'm recommending is that you insure for what you're seeing there. What is Homemaker Services and Home Health Aid? This is national. Find out what it is in your communities. And so if you insured for $4,000 a month, you would be insuring for what is potentially 80% of the risk of what is actually going to happen. And you will relieve the caregiving for that family. So this is important as we look at this, because I want you to understand that people have a certain tolerance for premium, right? They don't want to pay an exorbitant amount for this premium. So what we did is we said, okay, let's look at some traditional insurance and let's see if we can create a plan that is affordable, because studies have been done over the last decade asking consumers, would you insure this risk if you knew that you're maybe co-insuring part of the risk, paying for a plan that would maybe pay 60, 70, 80% of the care? Would you be willing to do that? And it doubled the amount of people that said, yes, I'd buy this. And then they said, how much would you be willing to pay? And the answer was, depending on, people in their 50s and 60s would pay somewhere between $100 a month to $150 a month. And so I said, what can you buy for that kind of premium? And I want to share that with you. So, and I put standard rates in here, married couples. So this is just 3 quick ways of looking at it. So I want you to understand that you can put an affordable solution in front of your client that will cover where the prevalent care is being received for the length of time that it is being received at an affordable premium. So this is just saying, hey, why don't you insure $9,000 a month, but we have no inflation protection on this? And it's a 2-year shared care plan. So when you look below and you see the initial policy maximum is $460,000, which is a big chunk of change, right? So that's like setting aside $500,000, and the premium is $3,000. For 2 people, that's $125 a month. So that's one way of doing it. Here's another solution. This is the more traditional. Remember, if we look back at how much home care cost, it was about $4,000 a month. So let's look at insuring $4,000 a month, $4,100 a month for again a 2-year benefit, shared care, and this one does have a 3% inflation protection on it. The initial policy is only $210,000, but over time, when they're 85, the benefit is $500,000, and the premium is again $3,000. You're going to see a trend here. Here's another one. This is $5,300 a month, 3-year benefit, but with 1% compound inflation. And yes, when you look at, I didn't mention that when we went back and looked at what the cost of care is, you looked at what's going on for home health care, and the home health care is inflating at 1% to 2%. So I think it's reasonable to put a 1% compound inflation on. And in over 22 states, that is partnership qualified. So again, now we're starting at $380,000. By the time they're 85, it's $500,000 again. And the premium, once again, is $3,000 or $125 a piece a month. So I'm telling you that if you put this kind of solution in front of your client, they will be shocked, quite frankly, that it's as affordable as this is. And then they may come back to you and say, hey, I don't think this is enough. Can I do a bigger benefit? Whatever. And then you can build it from there. But if you start the other direction and come in with the huge benefits, it's really much tougher to back down from that. So I'm just talking fast to give you some sense of what we're doing and what's working. So then the other thing that I want to talk to you about, and I know that you know this because it happened in 1997, in terms of the ability for people to deduct long-term care. But I will tell you, it's still news to everyone that doesn't own long-term care insurance, doesn't know about this. So it's still news. So I just wanted to I won't go through the whole, deductibility of long-term care insurance, because with the new tax changes, we're only able to deduct this for just 2018. But as a self-employed person, you can still deduct it in the same way after 2018, and I want to share that with you. So first of all, we've got this chart, and it does show when you look at somebody 51 to 60 that they could deduct $1,560 of their premium, and that, by the way, is $125 a month. So if you come in at those premiums and they're self-employed, chances are they're going to be able to deduct their premium. And certainly in their 60s and 70s, they're going to be able to deduct their premium based on these amounts. So let's talk about how somebody might do that. The second thing quickly is just a reminder that it is an allowable health expense out of your HSA. So there are people that have been putting significant dollars into HSA for decades, used to be an MSA, and have enough money to use this as a post-retirement healthcare fund. That's what I'm personally doing. So there's that opportunity to pay for long-term care tax-free. Then I just want to jump to how a self-employed person deducts traditional long-term care premium on their taxes. So if a person owns more than 2% of a flow-through entity, they cannot, from their company, deduct the premiums for themselves the same way that they can deduct it for their employees. So I actually own a subchapter S, and I actually do provide all of my employees with long-term care insurance. I can deduct their premiums from my company's income. because I'm giving it as a benefit. I can deduct 100% of their premiums as a company expense. I cannot deduct my own in that same way because I own more than 2% of the flow-through entity. However, I can deduct it on the front of my 1040, the same place where I would deduct my health insurance premiums. And I think it's line 29 or 39. I should have checked that first. I think maybe it's 29. But anyway, it's on the front of the 1040. And you can deduct up to this amount based on your age, okay? So we talked about it being my birthday. Well, the only good news about having a birthday is that I'm now, well, actually over into the 61 and over category. And so I can deduct a large amount of premium. So my personal premium is, I have two policies. One's $1,276, the other's $1,500. So my premium's $2,800. My husband's is $1,276, and the other's $1,780. So his premium is $3,056. So together we pay $5,872. And if I look at a marginal tax bracket of 33%, and yes, in the state of Minnesota, we actually have a marginal tax bracket of almost 10%, my marginal tax bracket, as an example here, would be 42.85%. The tax savings on my premium is $2,500. So I don't want you to forget how significant this is in terms of the tax savings for people that are self-employed. So I'm going to turn it over now because I just wanted to give you kind of a sense of what's going on in that marketplace. Still robust. And by the way, there still are a lot of really strong companies in that market space. What you'll discover is that they're mostly mutual companies now, but some of the largest mutual carriers in our country are still marketing long-term care insurance and doing it very successfully. So the marketplace reminds me of what disability insurance has gone through, and that is when I entered the business 40 years ago, every company sold life insurance, disability, and annuities. And now there's probably less than 10 companies that own the disability marketplace, and that's the same thing going on in long-term care. So it's a very niche product, but it has survived, and it's actually thriving within that community of 10 companies. So, all right, I'll turn the meeting over now.
Excellent. Thank you, Deb. That was great information. We did get a bunch of questions from that. There's a couple we'll throw back to you later on. Now, this is our first CFP attendance code right now. It is 133425. Again, if you want CFP CE, write down the code 133425. One last time, 133425. All right, so now we're going to switch over and kind of change gears a little bit, still in the long-term care planning area, and we're going to pass it over to Bill Borton, who's really going to kind of drive us into that, as Deb mentioned too, kind of growing area of hybrid long-term care insurance policies. So, Bill, are you here and ready to take over?
I am indeed, Jamie. So, at any rate, I've been in the insurance business for 36 years, but I didn't get into the long-term care part of it until about 8 years ago, when an older friend of mine approached me and said, I need long-term care insurance, and I need it fast. My wife is going to let me move where I want to move as long as I get a policy. And so I got in when all the big insurance companies were getting out, and the headlines were about big rate increases, and I ultimately ended up selling 2 Lincoln Money Guard policies as the first 2 policies I sold. And again, that was just about 8 years ago. Since that time, as Deb said, fewer companies are embracing traditional standalone long-term care. It still is very important product line, and I do quite a bit of business with several of those mutual companies for my clients. But what I have discovered is that the best policy is not the one that I think or some other insurance person thinks is the best policy. The best policy is the one that your client will buy and the one that will be in force when claim time rolls around. And so I'm just looking, here we go, getting my controls up and running here. Pardon me. I'm trying to, there we go. So boomers and insurance carriers have both been adapting to the trends. And so what we're seeing is more and more life insurance companies being able to appropriately price products that can pay for long-term care and that can at the same time have predictable results for insurance companies. And so a lot of the boomers have been embracing so-called hybrids, which is really a lay term that you see thrown around in a lot of the consumer press. But a hybrid really falls into one of several categories that we'll talk about in a moment. But boomers like hybrids because they don't think they're going to end up spending a lot of money and never using the coverage and having spent the money. So there's no use it or lose it objection. They also aren't nuts about paying premiums for life, which you do with just about all the traditional policies that are still available. And premiums have proven that they can go up. Now, there's been some rate stabilization since 2014, but it's still reasonable to expect that even some of these big mutuals will still see some rate increases over the next 20 or 30 years. Again, there's no perfect policy. It's the one that's going to be around, in force, and ready to pay when your client needs it. So hybrids fall into basically four categories. Life insurance with a 7702B long-term care accelerated death benefit rider, life insurance with a 101G chronic illness accelerated death benefit rider, life insurance with a 7702B long-term care extension of benefits rider, and single premium deferred annuities with 7702B long-term care extension of benefit riders. What a lot of gobbledygook that is. At any rate, let's start digging into this, however. And my control is a little sensitive here, bear with me. So the first variety is the 7702B accelerated death benefit rider. This is a life insurance policy. It can be universal life, an IUL, indexed UL, GUL, or even a survivorship UL with one of the carriers out there. And so you have the possibility of guaranteed premiums payable for a predetermined number of years because you have all the regular ways that you can fund the UL policy to make it guaranteed. You also have a defined monthly benefit, which is typically either 2%, 4% of the death benefit paid out monthly for some period of time, or the HIPAA daily maximum, which is currently, I believe, $380 a day. So they may be either reimbursement, which is how John Hancock pays, or cash indemnity, which you can get from Nationwide. The tax qualified benefits are received income tax free. If you die before the benefits have all been paid out, your beneficiary receives the balance. It's life insurance after all. Inflation protection, however, is not available. And this is one of the things that the people that like to bash these types of policies always point to. But I have an answer to that, and that is you gross up the death benefit to back into the inflation. Think about it. If 3% compound inflation is going to cause your benefit to be worth half as much in 25 years, then if you start with double the amount of benefit that your client needs now, in 25 years, they're going to be where you estimate they're going to need or want to be with an assumed rate of 3% inflation. So for instance, if $250,000 death benefit would provide an adequate amount monthly benefit for a couple years now, then a $500,000 policy is likely to be equally adequate in 25 years. With this policy, the rider's medically underwritten, comes with an additional premium charge, so you have to be healthy not only with mortality, but with morbidity. And again, Nationwide is the one company I'm aware of that offers a survivorship policy that covers 2 lives, and one can be an adult child. It doesn't have to be your spouse. So the next is the 101G chronic illness rider, and there's two flavors of this. This is not long-term care insurance. You don't have to have the partnership training to sell it. This is built into most UL policies that are available today, along with the terminal illness and in many cases critical illness. And you cannot market this as long-term care insurance. Be very careful with this product because I like to say it's an E&O claim waiting to happen. When I use this, and this is again available with just about all of the other types of insurance, UL insurance, plus a couple of companies sell term insurance with this type of a rider. So you have the possibility of a guaranteed premium. You have an undefined monthly benefit, however, because there's no premium, there's no morbidity underwriting. And so you really find out at the time you become chronically ill how much of the death benefit you're going to be able to accelerate. A general rule of thumb is it's a percentage based on your age. So if you were age 80 and became chronically ill, you might be able to accelerate 80% of the death benefit. One of the gotchas with this is just about every company says that you need to be deemed, your chronic illness needs to be deemed permanent in order to qualify for benefits. And that's going to be between your attending physician and the claims people at the insurance company. Not a good situation in my estimation. Here again, the benefits are intended to be income tax free, subject to the HIPAA daily max. Your beneficiary gets what hasn't been paid out. Same thing, no inflation available. You can try backing in. I like to say that people who buy this policy are ones that may be uninsurable for traditional long-term care and couldn't qualify for a 7702B rider. And this is better than nothing. The other kind of 101G rider is one that really looks and walks and quacks like long-term care insurance. This again is a life insurance policy, and there's no requirement that the chronic illness be deemed permanent. It is medically underwritten. There is a premium charge. You can accelerate 100% of the death benefit, again, typically 2-4% of the death benefit or the HIPAA daily max. And at this point, American General, Protective, and Prudential are leading the way with this particular product. And so you can really design it around a traditional current assumption UL contract, an index UL, or a guaranteed UL. And it really functions as if it were long-term care. What I love about this contract also is it pays cash, as does the other types of accelerated death benefit, long-term care or chronic illness riders, but it pays cash. And as Deb was saying, most care is at home, most of it's provided by informal caregivers, and with a traditional policy, none of them will reimburse informal care to any great degree these days. There's a couple that will provide some benefit, but with these hybrids, so to speak, they're always paying out cash indemnity, again, except with a couple of the 7702B carriers out there. The next policy, which again is the one that most people think of when they think of hybrid policies, when you read the articles in Kiplinger's and Money Magazine and the like, is a life insurance with a 7702B accelerated death benefit rider. This is your combination policy. This is your asset-based long-term care, your Lincoln Money Guard, your Pac Life Premier Care. And so these policies have been around in one form or another for many years. I know Lincoln and State Life have been selling these kinds of policies for, I think, 25 or 30 years. And so you end up having a life policy and an extension or continuation of benefit rider that's built on the 7702B chassis. And so you typically will end up with a 6-year benefit period, although it could be 5 or 7 in some cases. And one carrier, State Life, actually offers a lifetime benefit policy at this point. Here we go. And so in this case, you are looking at a policy that has a large degree of self-funding because these policies typically are sold with a single premium. Some carriers are starting to offer options of longer periods of time, but the sum of the parts can end up being significantly more than the single premium. So these policies really are designed for people that can move chunks of money from CDs or old life policies through 1035 exchanges and the like into one of these asset-based or life-linked policies. And so think about it. If you plunk down 100,000 and you get, depending on your age, maybe a death benefit of $130,000, and you might get $300,000 or $400,000 of long-term care benefits paid out over a 6-year benefit period. This could work really well if you were going to need care for 4, 5, 6 years. If you only need care for 2 years, which typically is the case with most men, then you're going to be largely self-funding the benefit, which is one reason why I tend to shy away from these policies for men and use the chronic illness accelerated death benefit policy that allows you to accelerate the full benefit and doesn't require permanency. These contracts are available from a number of companies. Most of them still are selling reimbursement policies, but a couple, Securian and Nationwide, are selling cash indemnity policies. And again, these are becoming more and more popular. These policies are underwritten by a phone interview and a prescription drug check. They're very, therefore more easy to obtain. That doesn't necessarily mean you can be less insurable, but again, keep in mind that first couple of years of the claim is really going to be the extension of the acceleration of the death benefit, which is usually not a whole lot more than the single premium that you've paid in. So again, think about what is the likelihood of needing care. Now, if you have a man who is really concerned about dementia because they have a family history, then this might be a more appropriate product to sell your client, again, who may be male, but may be more concerned about a longer claim. The last policy is, and boy, is this thing sensitive, the deferred annuity with an extension of benefits rider. There's really only a couple of carriers that sell these, and these are a single premium deferred annuity. Typically, $100,000 or up is what you see people pumping into one of these. And they are basically a way of self-funding your claim with an annuity. And then if you're still chronically ill after a couple of years, having a rider kick in that can cover you for another 2, 3, 4 years, similar to the life policy. And these policies are available for people who are significantly older and in poorer health, again, because of the large degree of self-funding. You do have surrender charges. They are underwritten with a phone interview and a prescription drug check. And so they are not for everyone, but I've been finding more and more elderly people in their upper 70s that maybe even have been turned down for traditional long-term care can qualify for one of these policies. So I've gone through a lot of information very quickly. My contact information is on the next slide. If anybody wants to get in touch with me, if they have questions we don't have time for today, let me know. But again, these policies are really designed for the individual based on their circumstances. They give you the information that you need in the fact-finding interview when they talk about their age, their marital status, their health history, source of funds to pay for the policy, their preferences about where they want to receive care and whether informal care and therefore cash indemnity is going to be necessary, what state they live in because of state approvals. These are all things that can help you gradually winnow and sift through all the possibilities to kind of come to a clearer understanding about what's the best policy to recommend. So enough of me for the time being. Jamie, back at you.
All right. Thank you, Bill. Yeah, we've got about 10 minutes left now. So we've got 2 questions I built in here that I wanted to ask both of you. I thought were very useful questions. We have a lot of questions in the chat thing. Actually, I think we're probably nearing like 100 questions in there, so we're probably not going to get through all those. I'm going to grab a couple. Bill and Deb will be both given all those questions, so if again both their contact information was in here too, but we'll get to a couple of them. So the first one I always find very interesting, and Deb, we'll start with you, then go to Bill. Just kind of a quick, if we're looking at, as you said, maybe you have 200, 300, 400, 500 clients. How do we quickly look at them and say, how do we distinguish who might be appropriate for what type of planning, hybrid, traditional, Medicaid? Any rules of thumb you can give us on this? Deb, if you could give us any insight, and then pass it over to Bill too.
So I think that, if you have people that are self-employed, are partners in a medical firm, a law firm, or literally just have even a side business where they could deduct the premiums, and I would start looking and saying, okay, those people might be appropriate for a traditional policy because of the deductibility. The other thing is that if you have males, single males or a gay couple, then I think traditional is really priced phenomenally for males. On the other hand, if you have single females or a gay couple of females, then I might actually look more towards the hybrid solutions, because life insurance is actually priced less for females, and then the rider, even though it might be a little bit more than a male, it's still significantly priced more as a life product than a long-term care solution. So we find a lot of single females. We tend to look at the hybrid policies. And again, in your late 60s, 70s, the hybrid policies, if people have a lump sum to transfer, that often seems to be the best solution in that marketplace. By the way, there still is 10-pay in the traditional long-term care space. There's two companies that have 10-pay, Thrivent and National Guardian Life, and both of those are available on a brokerage basis. So you don't think that is totally gone, because it's still in the marketplace. So
okay.
Yeah, that's how to answer that.
And Bill, anything you want to add kind of on this, where you see using or kind of policies today?
Yeah, most of the inbound activity that I get from fee-only financial advisors that I collaborate with, and from the boomers that seek me out, they're wanting to know about hybrids. They've seen the headlines about rate increases. They've read the articles in the various consumer publications that talk about use it or lose it, and companies getting out of the business. And I don't beat that drum. I still, again, sell quite a bit of traditional standalone long-term care. But again, the best policy is the one the client will buy. And if somebody has those objections and they want guaranteed premiums, and they have money where they want to be one and done or pay in just a few years, that would tend to point towards some type of a hybrid. If there's a need for life insurance, then an accelerated death benefit product is appropriate. And then it really comes down to preferences too. With informal caregiving and with the need to be able to have cash, you just don't get that with the traditional standalone policy. So it really comes down again to preferences.
Yeah, absolutely. And I guess if you're saying it, I know both of you kind of work on both ends, but if you were working with a client or an advisor working with clients, what is the kind of one piece of information you give them about long-term care planning, right? Like, and Bill, we'll start with you this time, then Deb can kind of wrap up on this one. What's the one piece of advice you'd give everyone?
Well, Deb's advisors and my advisors are different. I'm working with fee-only RIAs that don't sell or manage insurance, so I have a bit of an uphill battle with them because in the past, they've always believed that if the client has sufficient assets, that they don't need to buy insurance. In fact, many of them don't even think they need to have the conversation, which makes my head want to burst. And so I have to get past the fact that assets don't pay for care, income pays for care, and then talk about the different compelling reasons why risk transference and other people's money makes sense. With clients, I take the approach that Harley Gordon talks about, And it's not the risk, it's about the consequences. And so clients aren't as opposed to buying insurance once they understand their options, and that other people's money and risk transference are concepts that resonate more and more, again, once their eyes, ears, and minds are open.
Excellent. And Deb?
So what we're finding successful, I'll share with you one asset that our industry has. I don't know how many of you are familiar with the lifehappens.org. That's the got milk, if you will, for the insurance industry, and it's supported by most insurance companies. And and so they have assets that are available to most of us as agents, and they have a really spectacular brochure that we use, and it's called What You Need to Know About Long-Term Care Insurance. So if people want to reach out to me afterwards, we might be able to help you with that. So that's one thing that we use to kind of introduce the topic, and it's a really good learning piece. And then the other thing that we're finding success with, what we're doing is we're coaching advisors to pick the best long-term care standalone recommendation and the best linked benefit recommendation, and bring those both to the client and let the client choose which is the best solution. And we're having tremendous success doing that. You can't bring 4 long-term care policies and 4 hybrids and say, oh, here we are. Just bring one of each that you have already screened for them based on their health, based on what their goals are, their affordability, whatever it is, and then put those in front of the client and coach them through the process of choosing one or the other. And we're having tremendous success doing that.
I've taken that approach on occasion, but more and more, I'm getting the client to tell me through the discovery and fact-finding process what it is that they really want, and then that's what I end up showing them. One other thing for the advisors on the webcast, Dave Littell, Jamie, and I recorded a number of videos earlier this year that are on the college's library, where again we go into more detail about solution development, fact-finding, and the different types of hybrids. And again, I would be more than happy to communicate with any of the people on the call to go into as much detail about any of these as you would like.
Yeah, absolutely. Yeah, I know we've built videos with both Deborah and Bill on there on the on our Retirement Income Center. The videos, actually, we'll have new ones of Deb and I coming out here pretty soon by the end of the year. So now I just want to, I've got 3 minutes, a couple wrap-up pieces here. We're not going to hit any other questions at this point. If you submitted your questions, we will pass those over to both Deb and Bill. They'll be able to reach out. You'll have their contact info at the end here too. But again, this is complex, right? Keep up with the industry as things are changing. We do have an upcoming webcast, the last one for the year, with myself again, kind of moderator, Dr. Craig Lemoyne, who many of you have probably had as a professor now at the University of Illinois, running their CFP program, and Margarita Chang, who's one of my good friends. Rita runs a very successful Blue Ocean Global Wealth, very impactful person, one of the women to watch from Investment News, very powerful person. We'll have a link to that in the follow-up email, so register for that. Again, another hour of CFP on December 12th, 2 to 3 p.m. Eastern. The last CFP code, and then we'll give you the survey link here in a second that will go out in the chat box. The last CFP tenant code is 768542. And 768542. Last pitch here. Both, as I said, Bill and Deborah are part of the RICP program, Retirement Real Retirement Readiness. I said just data on that. 95% of designees said they were better able to serve clients. 98% said it was a good use of time. 99% said they really had more information around healthcare, Social Security, Medicare planning after going through the program. So again, I want to thank Deb and Bill for joining us. It was really fantastic. I always learn every time I listen to both of you, so I want to thank you. Thank you for the attendee. Survey is in the chat box right now, so if you want to click on it to your browser, copy that out to kind of get CE for today's webcast. Again, thank you for you that are along college, and for those of you who are not, feel free to check out the programs that we offer. Thank you, everyone. Have a great day, and we will you will get a follow-up email also with the link in there and for the next web. Have a great day. Take care. Bye.